companies did cut their dividends, so no question about that. You mentioned the big four banks. I can absolutely ensure listeners the dividends were slashed significantly in the COVID and immediate post-COVID period.
Welcome to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mancell, founder of Mancell Financial Group. This episode is on the FTSE Australia High Dividend Yield Index, which some investors may know is tracked by Vanguard's VHY. And the index is designed to represent the performance of companies with relatively high forecast dividend yields in Australia. And dividends are always popular with investors, so comparing high yield returns to broader index returns can be an interesting exercise. Your Investment Philosophy, a book we wrote, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make us tap the sign. These are simple concepts. We'd like investors to better understand risk so they can make informed decisions. First up, so reaching for yield. A few points about index methodology. It's an index with a screen, and when we're talking about the high yield index itself, it's only been around since 2011, and Vanguard's VHY arrived about 6 months later, but the managed fund version has been around since 2000. Then it initially tracked the ASX 100, and then in 2004 it tracked an ASX 200 index, which excluded REITs. So more or less prior to 2011, if you wanted dividends, you had to get more of a large company tracker. But Peter, a lot of investors get hung up on dividends, but there's other considerations that come with them. It's not just free money, and it may mean paying a bit more tax.
Certainly. A lot of investors do focus on yield. They get excited about the size of dividends, and then you add franking credits to those dividends in many cases with Australian shares, and that tends to be quite a strong focus. But it's important to remember that there are two components to the returns from shares: the dividend, with or without franking credits attached, and the capital appreciation that tends to occur over time where companies do better and better with the passage of time. Investors need to consider that dividends and franking credits together are both taxable income. They're fully taxed. Now, if you don't pay any tax, well, of course, that's great. You've got 100% of the dividend and you haven't paid any tax. But if you do pay tax, then you're going to lose a portion of that dividend plus the franking credit to the taxman. If you get capital appreciation in the share price and sell a share for a gain, for individuals and for trust distributions to individuals, you're only paying tax on half the gain. So for someone with a marginal tax rate, the fact is that $1 worth of capital gain you'll pay less tax on than $1 worth of income in the form of dividends. Capital gains are very much more tax efficient for most investors after you add dividend to franking credit minus a marginal tax rate. And if you've got $1 of that receipt in the form of income, you'll pay more tax than if you get $1 of capital gain, 50% of which is exempt from tax.
A periodic performance. We've used the ASX 300 for comparison, and the high yield offering has actually done quite well, not so well over the 10-year period, but since inception, it's leading the ASX 300.
Yeah, and if you have a look at the first 5 years of that decade-long period, years 2, 3, 4, and 5 going backwards were years that had very low interest rates. So a lot of investors chased yield because they couldn't get a decent interest payment on a term deposit or other similar conservative investments. That pattern that we're looking at there is very much random, other than the extent to which it correlates with what was going on with interest rates over that time.
And calendar year returns. So looking at calendar years is probably a basic thing to do, but in this instance, it probably feeds into that discussion why the 10-year performance is lower than the ASX 300. Higher concentration of banks. They sort of peaked for a little bit in 2015, 2016, also ran into the Royal Commission. They and Telstra also had a high weighting in this index, or higher than it would have been in the ASX 300, and Telstra peaked in 2016. There was also another issue which FTSE have addressed, a problem that came up with BHP and Rio Tinto. They had share price falls in 2015, which made them eligible for a higher weighting in the index based on their yield. The only problem was in 2016, after they fell, they then cut their dividends, which meant their weightings in the index were cut again.
Yeah, I find another interesting thing here is that there's sort of periods of time where the high yield tends to be in favour and pursued by investors for a period, and then it goes out of favour. When you look at 2014 right through to 2021, an 8-year stretch where it was out of vogue with investors. Then interest rates fall dramatically as governments around the world, tried to stimulate the economy in the post-COVID environment, and suddenly it shoots the lights out with a plus 10% return the next year. There's no doubt in my mind that was investors, chasing yield they could get from certain shares when they couldn't get decent returns from interest-bearing securities.
And I think there's some dividend cuts through COVID and some APRA caps on earnings payouts. So when they ease off in 2022, you probably see that reach for yield again.
Companies did cut their dividends, so no question about that. You mentioned the big four banks earlier. I can absolutely ensure listeners that the dividends were slashed significantly in the COVID and immediate post-COVID period.
Growth of wealth. So over the long term, those index construction hiccups haven't mattered, but as you can see on this chart, monthly movements are relatively similar to the ASX 300.
Yeah, I look at the results here, and there's a lot of similarity to the ASX 300. When you look at the COVID dip there in the middle, those two indices all but mirror each other, and there are periods where the high dividend yield index does deliver a superior result, but there's points where it actually reverts back to the mean. I think that the difference that we can see on the screen there, whilst not insignificant, it's not huge, and I wonder if it's actually a true pattern that we're seeing, or is it just noise?
The range of returns and the COVID bounce, probably the best 1 year period, and it seems the issue with BHP and Rio are around the worst 1 year period.
Again, this particular chart is not much different to the broader market over the longer haul. It's very, very similar. So I'd say to investors, if you're looking at this particular high yield index, don't think of it as a way to get rich quick. Don't think of it as a way that's going to outperform the market significantly. I just don't think that the historical evidence would support such optimism.
Enrolling annual returns, and this is what it is, but we'll go on to the next one for a bit more context, and we'll add in the ASX 300, and they're not exactly the same. Correlation is 0.95. So if you're going to use one of these, just pick one, because some people find both of them in their portfolio somehow. Just pick one and move on.
Yeah, indeed. I look at this again, and you look at the amount of above and below the line results, from each of the indices. And through the passage of time, there's just not a lot between it at all.
Historic chance of positive or negative, a little lower than you might expect for 5 years, but the index has only been around since 2011. So, yeah, as you say, maybe noise.
Yeah, it's a fairly short data series, which means it's going to be hard to draw genuine conclusions from that you can have confidence in. A 14-year period, when you're trying to pluck out, first of all, periods of 1 month, then 3, then 1 year, then 3, then 5. The 5-year periods, there's lots of overlapping there, so it's probably a bit early to say that this is any better or worse.
And largest fall in time of recovery. Obviously, this is COVID, but it's a reminder that high yield funds aren't term deposits. They fall exactly like stocks because they are stocks. And the ASX 300 saw a 27% fall at the same time. And we saw earlier there was another 20% fall in 2015, 2016, and dividends aren't guarantees.
Absolutely. Just because a stock has been a high dividend stock in the past doesn't mean that it will be through a market downturn like COVID. You could point to any number of businesses whose profitability was slashed during COVID. And as a result, the dividends that followed were lower for a period at least. High yield stocks are nothing like term deposits, and anyone that buys a high yield stock for the purposes of generating income has to accept that there will be volatility, especially in the capital value, and what's more, can genuinely be volatility in the future income stream.
And risk and return are efficient frontier, so relatively similar to the other ASX indices. And as REITs are excluded, an example of what they've done to the far right.
Yeah, there's over that particular period, REITs have delivered an extra strong return. There's no doubt about that. but you paid for it in the form of volatility along the way. I look at that and go, well, that's just a risk-return trade-off. You've accepted more volatility and you got rewarded for it over that particular period. It would be very interesting to see whether the same sort of outcome relationship would be there if we were looking at, 25 or 35 years worth of data rather than just 14.
And sources and descriptions of data. Thanks for your time.
Okay, yeah.